Hello, everyone. Greg Sykora here with Mark Zavitz. Today, we're going to go over some interesting pieces I found on investing when markets are reaching all-time highs like they have been in the month of April, where we are today when it comes to market risk, how a portfolio of 100% stocks has performed at the worst possible times if you were to take all your money and invest it at the market highs, as well as an analog for the market we're currently in, which appears to be a stereotypical bull market. So let's get started. First, with the scary stuff. On this slide, we see market expectations for inflation in the US. The US and Canadian central banks, and even we'll say European central banks, the ECB, tend to target inflation around a 2 to 2.5% rate. But given the war and its effects on energy and commodity prices, markets are signaling that inflation is likely to stay persistently above the Fed's 2% target, even over the long term. Keep in mind, this chart isn't showing actual or current inflation. It's showing the market's future belief of where inflation will be. This tends to have an influence or affect demand of risk assets, which typically causes them to reprice downwards. Mark, what's your perspective on inflation and what it usually does to stocks?
Well, Greg, I don't have any firm data, but I'll just work with my 42 years in the business. And I would say whether it's 75% of the time, generally when inflation expectations move up significantly, like they have in the last 3 or 4 months, bond yields move up as well, and they have, and that majority of the time that's pretty negative for equity valuations, right? They generally sell off. They look at higher bond yields because of higher inflation expectations, and and money rotates out of stocks generally. Who knows? It goes to all different places, but yeah, they generally sell off, Greg. So it's not happening this time. So for whatever reason, we've got $100 oil, significantly higher inflation expectations when you include energy into the
Yep.
inflation basket. And we just had a phenomenal month in the stock market.
I know. Exactly to your point. It's not what's happening with stocks at all right now. Earnings expectations for the year for the S&P 500 were in the high single digits heading into the year. But so far this year, expectations are being completely blown out of the water in a good way. We have similar year over year earnings growth numbers as what we saw last year. And of course, that's on a higher base amount. And it appears as though AI is finally starting to drive significant revenue and improve margins for big tech and big tech stocks. So, like in, I guess, Charles Dickens, we've got a tale of two cities. On one hand, we've got a world where commodity prices are high again, energy prices are soaring, it's creating inflation. We got war in Iran. We've got a lot of uncertainty out there. We've got a lot of debt. Nobody knows as well how long this war and inflation is going to last. But markets are starting to worry. They're not panicking, starting to worry, as we've seen on the last slide. But on the other hand, we've got one of the best corporate profits and some of the strongest companies we've ever seen in the history of the market. Earnings growth and cash flow it's never been better, specifically in the US with the S&P 500 and the 500 largest companies. On top of that, these companies are all suing Trump, or not all of them, a majority of them are suing Trump and the Trump administration to recapture billions in tariffs that they unlawfully paid. But ironically, it was actually the consumer who paid them through higher prices. So what does this mean? This just means that when they get the money back, it's going to be a boon to their bottom line. It's crazy. As an example, from an earnings standpoint, Google, Alphabet Their profits were reported yesterday on April 29th, and they absolutely crushed expectations. They earned $62.6 billion of revenue in Q1 alone, or $5.11 per share. That's an 81% rise from a year earlier. A big portion of that 81% was margin created by AI investment. How does AI do that? Well, for Google Alphabet, their employees are significantly more productive and they need less employees to do the same job. The market value of Google has also doubled in the last year from $2 trillion to $4 trillion. Even with the correction that we saw in this stock when the war was announced, and we talked about this in our last monthly update, it's been a great company to own, and you guys all own it in your portfolios. So that's great and all, Greg and Mark, but I'm a client. I'm skeptical. What happens if or when the music stops? Well, here's an interesting slide I found showing every time the S&P 500 index went down 20% or more. As a reminder, as I said just previously in the last slide, the S&P 500 is basically the 500 biggest companies in the United States. And for clients like you, it represents about 40% of the stocks or the equity sleeve of your portfolio. The takeaway from this is even if you invest at the worst possible moment in time, markets historically recover in about 2 years. The outliers being the dot-com bubble and the global financial crisis. And for 99% of clients watching this video, your portfolio is not 100% in the S&P 500 index. You're in either the conservative or the moderate model that would go down only a fraction of this, and the break even would be in a much shorter time period. So are the returns we're seeing in our portfolio today unprecedented? It might feel like that, but it's actually no. This slide compares two major bull markets. The light blue line shows the S&P 500 performance from 1982 to 1999. The darker line from the bottom of the financial crisis of 2009 to now. Both include frequent drawdowns along the way. You can see the bumps. It's not like a straight line. They're two of the strongest bull markets in history, starting from a major crisis. But the main takeaway is that today isn't historically extreme. This bull cycle that we're in, it's a long one, but not unusually strong versus history. And in my opinion, is a great counter to anyone who's, a stock market bear who thinks perhaps we've gone too far. And finally, what I consider to be the most interesting slide of this month's update. Don't let all-time highs scare you out of investing. It's a slide by a PM out of the United States, Ben Carlson. He's a guy I trust. He puts out a lot of these pieces, mostly just dealing with his clients and the objections that he sees. He has a team who does it for him. But basically it says, going back to 1950, and this is what really surprised me, returns are nearly identical or slightly better going forward when you invest, when markets reach an all-time high and you invest your money. Isn't that crazy, Mark? Doesn't that feel kind of crazy?
Well, it's logically it's hard to it's hard to work that through. But but this is accurate data, and this just confirms that it talks to the fact that we have clients that get very nervous when the media pumps out the fact that we're at all-time highs, and they some of them are very cautious and they wait, and it just goes to show, some of the clients will wait for months and years to deploy capital, and not many, but a few, and look at what they miss.
Yeah, it's like, should I wait for a pullback before investing or taking on any risk? No.
No,
you didn't have this data, right? You didn't have this data 20, 30 years ago. That's what technologies afford us the ability to do, is to analyze the trends and look back and say, what makes sense. And when markets are making highs, we've had 50 over the last year. Investing in those highs historically has not led to like a worse outcome. In fact,
Exactly.
results are better on average. So
Yeah,
if you're
no,
trying to wait for a better entry point, like we really don't for many clients. There's maybe a handful that do. It often just means we're missing out on time in the market, and nobody can time the market successfully, and you're probably going to get a worse outcome.
absolutely. Well, the data that we used to get 20, 30 years ago was simply, here's the S&P 500 return over 20 years versus here's what the average investor does when they try to dipsy doodle in market time, and it's just the impact is just market timing impact is so negative. Those people make half. Their
Yes,
compound returns are 5 instead of 10.
exactly. Exactly. No, it's true. And unless you've got millions of dollars where you can afford to make half, then most of the time you want to just be invested and not trying to time the market, and you'll enjoy a much better return in the long run with that approach.
Exactly.
All right, everyone. That concludes our update. Thanks so much for tuning in. We look forward to presenting our next monthly update at the end of May. Take care, everyone.
Yep. Have a good summer, everybody.